Good afternoon, welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is October 5th, 2023, and today we're going to discuss the tech bubble. Is history repeating itself? And so today we're going to look a little bit about the tech bubble from 2000, but comparing it to maybe what we're seeing now. Maybe the rally in the markets, the climb that we're seeing is purely tech bubble like we saw in 2000. As you can see here on the QQQ, we're near the highs. We pushed back to near the highs even after this correction, and we're holding up near those highs. The question is this pattern in 2001, 2002, 2003, the AI tech bubble, similar or representative of what we saw in 2000? Now, there's a bigger gap, a bigger space between these peaks from here and here versus what we're going to talk about from here to here. And so what I'm going to do is I'm going to dig into this with the view of comparing the fundamentals behind it. We can talk about the technical pullback and what we might look at, seeing that the double top or lower highs became a pullback, but we can look at the percentage. I want to talk about debt, which we've talked about before. I want to talk about interest rates, and I want to talk about growth versus market valuation. So to start, let's go to the TNX. Starting with the TNX is going to give us a quick view of where the market was yield-wise back in 2000 as well. So going back to 2000, you can see we had a 6.8, 6.5, 6.7% rate all through here. So if we're looking at that interest rates, what we're asking is, what was the cost to borrow? So if we're looking at this, we're asking the question, what was the cost to borrow in the 2000s? 99, 2000, 2001. And we're saying it was near, I'm going to call it 6%, because we had a little above, a little bit below. We did go as high as 6.5%. Certainly saw prices push through there. And when we saw prices break down, when did the Fed start cutting rates? When we see 2001, 2002, we dropped all the way down to 3%. And so we can go back and look at the Fed cuts that happened during there to stimulate the economy, but that 6% level, from 5.5 to 6% level, it's within range now. We've climbed from a 0.4%, 0.398%, all the way up to 4.7%, and we are within range of the highest interest rates we've had already in 20 years, and approaching the same levels that we had during the tech bubble. So the tech bubble was pushing higher despite the fact that we had to borrow at 6 and 7% rates, which would be, that's the 10-year treasury rate, which would be an indication that we were seeing commercial loans at 8 to 9%. Commercial loans were being offered at 8 to 9%. I personally remember that because I did SBA loans in the early 2000s. So as we're looking at that move, the cost to borrow for a company is 8 to 9%. The tech companies were borrowing at 8 to 9%, but they were also getting a lot of capital from investors. If we look at that time frame and ask the question, what was that interest rate and what was the total debt for consumers? What we need to do is say, if we have that high of debt during that time frame, what's going on now and what was going on then? A couple of weeks ago, we talked about total debt. And as you can see, the total household debt is $12.35 trillion, $12.35 trillion in household debt. The non-household debt is about 4.71. So if we have $12.35 trillion, we can see in 2004 we have 6 trillion. So we've already doubled the amount of total debt since 2004. But this isn't accurate because it only goes back to 2004. So I had to download the information from the New York Fed to see what debt was like when we were borrowing and paying 8% rates. So if you look at this chart, we have all this information here. And if we talk about the total balance of data, this is in trillions. So in 2000 and 2002, first quarter and second quarter, we had 5.6 to 5.25 trillion in total consumer debt. If we call it 5 and we're talking about 12 to 13 right now, what is the multiple? If we compare it to the 12.35, then we have a 2.4, call it 2.47, so 2.5 times multiple. 2.5 times more consumer debt as we did in 2000. All right, so 2.5 times more debt. Well, did we have 2.5 times more growth? We need to look at the GDP. So here is the GDP, and it's GDP total and per capita. And you can see which year we had higher GDP and negative GDP. Anytime we had a negative, that was obviously recessionary. 2009 we had a recession. That was for the year. not just 2 quarters, but the full year. So if we go back, we have 25.4 trillion in GDP. As we scroll down and we look at what was going on in 2000, we had 10.25. Guess what? Almost a perfect match. So our debt has grown at the exact same rate as GDP total. So far, they're mirror images of themselves. So far, they're in agreement. Consumer debt went up, total debt went up, and GDP went up at a multiple of 2.5 times. Now, what you'll notice here before we leave is, as you're looking at the data, one of the things you might see is that the data here said that we had 36,330 of per capita GDP. So the total per capita GDP was 36,330. Now, if we scroll this back up and look at the current, that's 76.39. So we did not get 2.5 times, we got 2 times. So there's a little bit of disagreement in that number, but what that would tell us that we actually had population growth faster than GDP growth or faster than debt growth. And that is fine. We just saw an increase of about, in a 22-year time period, we saw an increase of population that reduced the per capita in GDP. We're not done. So if everything is the same in 2000 as it was in 2002 and 2003 as far as debt and growth and almost the same as interest rates, are we setting up for the same problem? There's one other area I want to look at, and this is called the Buffett indicator, as what it's referred to. The Buffett indicator is this. How does this GDP number attach to or mirror or ratio against the total valuation of the stock market? And so if we're going to take a look at this and look at GDP, total GDP versus the market, our current market valuation, the aggregate U.S. publicly traded market valuation, is at $45.6 trillion as of last week. $45.6 trillion. And the annualized GDP as of last week as well is 27.39. So it's increased again, which leaves us with a 167% of GDP valuation. Now, what does that mean? Does it really mean anything? What that's saying is if we take all the total publicly traded stocks and say, what is it that you are worth? And then ask, what is it that we produce in any given time frame? What kind of multiple should we expect? And how does that multiple compare to what we're seeing here? And what this is telling us that we are seeing that the total market value is about 1.7 times what the entire GDP is. So this, just the publicly traded companies are trading at 1.7 times what the entire economy, man, woman, child, small company, big company, mom and pop shops, non-publicly traded companies account for, and that is, we're trading at a valuation of 1.7 times the GDP. This is actually very, very high, considered very overvalued, overbought. So what I'm going to show you is a little page that shows us these numbers and the percentages and the change. And we're going to look back to that 2000 time period. So again, current market valuation of the S&P 500, 45.62. We already know that the QQQ or the tech stocks are more highly valued. And what we're looking at is, where does that fit into history? So here is the Buffett indicator standard deviations based off a historic trend line. Now this is the flattened out zero as a historic trend line. It's kind of the linear regression model. I will show you one that follows equities as far as prices go, but this is just standard deviations along this line. And as you can see, we broke out to 2.5 times the GDP in 2021. We pulled back and bounced off a standard deviation and climbed back up again. So we already know that we're at 1.67, and as of this week at 1.2 standard deviations. Last week we were higher. Last week we were much higher, so we were at 1.6 times, or 1.6 standard deviations. Now, it's not just that we are overbought, overextended, that we are trading significantly higher in valuation of the market versus GDP and actual growth, but my question is, what's happened in the past? And we can see that in 2008, the market wasn't that overvalued. 2008, 2009, 2007 really when we peaked out, and the sell-off in 2008, we were barely past the historic trend line, and yet we corrected and fell down because we had that crash in the market and the home values. So we go back to the previous time where we were overpriced, and you'll notice it was March of 2000. So March of 2000 was the absolute peak of the valuation of equities versus the GDP. And you can see we dropped down, traded back down, and we crossed that zero line in 2003. So in 3 years, we crossed that zero line, got below the historic trend line, and we actually became deeply discounted after the 2008 crash. So it can take quite a while, but it's about 2.5 to 3 years to get back through that zero line. I'll show you something more important here shortly. We oftentimes talk about stagflation. And stagflation, if we go way back, and this is the baby boomer acceleration, the 1950s, which were a great business cycle, and we look back through here and we saw that peak above the 2 standard deviations, went past the 2 times 2 standard deviations up here, and I'm trying to get my line to line up on it. There we go. And that was in 1968, October of 1968. And by the time we crossed below that zero and became discounted, it was April of 70. So about 2 years. And when we really sold off and found a base and kind of bottomed out, it was 4 years later, 6 years from the original peak. So these economic cycles, when we become highly overvalued, usually within 2 years of getting past the 2 standard deviations, at least based on history, then we saw these massive corrections. Interest rates back here, super high. Interest rates back here, at a little bit higher than where we're at now. Interest rates right now, basically what they were in 2000. So interest rates are supportive of this, overvaluation of the equity market compared to GDP and growth, and looking for a mean reversion move. Let me show you something. When we do it as a percentage of GDP, and we look at it not just with standard deviations, but percentage of GDP, now you can see that 1968 level, we're about 100% of GDP. Pulled back below the curve and below 50%. Over here, we reached 150%. So 100% to 150% during the dot-com bubble, and we pulled back from 150% valuation all the way back down to 50%. Now we've reached 200. So each time we're increasing by about 50% higher valuation GDP to, or valuation of the market to GDP. Well, we've reached 220, 207, 208%. Let's see, our highest level I think was 219. And then we've pulled back a little bit, but theoretically if we pull back to the 50%, we're talking about a correction that could pull back all the way back to the 2008, 2009 lows. If we just pull back to the trend line, that means that we could erase all the price action up to and including 2016. So we could be looking at a continuation down there. One more thing to look at. And I like this one because it gives the full representation. This is the indicator ratio with the standard deviation bands, but instead of flatlining it as a linear regression, it lets you see the overall growth and expansion. You can see that our ratios here have become wider and wider and wider. So as we're watching this, the top line is at 2 standard deviations. We've gone past the 2 standard deviation, we pulled back to the 1 standard deviation, and right through here to pull back to this mid price again. Now you can see the upward trending compared to history. You can see that when we become overextended, we do have a tendency to pull back past the linear regression or midline and down to that 1 standard deviation negative or negative 1 standard deviation move. And you saw it happen here and pull back here. And so if we pull back all the way to the 1 standard deviation or negative 1 standard deviation move, we could be looking at a drop all the way back again to 2010, 2011 as far as the equity prices. Now we can only go back to 2009 on this chart on the PE ratios. And this is the price of the Qs or the Nasdaq, and this is the PE ratio. So you'll notice there's this massive spike. This is where we kind of get a little bit of maybe opportunity to still see not as aggressive a sell-off. We had a little spike in 2016 all the way up to 95 and then pulled back down pretty aggressively. So I want to kind of ignore this data and focus on this data through here. We had a peak of 29 here. Over here we had a peak of 29.6. So a PE ratio of 30 when you adjust for interest rates, at least the calculation for interest rates and the cost of it, or the adjustment for a no risk premium, it's similar to having a 35 to 37 PE ratio back here. And if we look back to 2010, as we're coming out of the pullback and the recession, we were at 15. So if we see a pullback out of the Great Recession at 15 and we're up at 30, theoretically we're twice the cost, twice the price to earnings from 2010. We're up at 29 and we were at 13 and 15. So we're double the price to earnings on the Qs compared to 2009, 2010. Now, because I can't go back to 2000 with this one, we're going to go and look at the S&P 500, and this is, again, maybe where we get a little bit of stay of execution as far as the market goes, and that is going back and looking at the S&P 500's PE ratio by year. Again, there's your 2000, your spike to 70 in 2000 and, what are we at, 2010? Right at that same point. And you can see we had a higher level here, and so let me zoom in a little bit better so we can see, what is that, about 2003. But we had a peak valuation of 33, and you can see we were at 37 in just 2 years ago. Right, we're talking about just 2 years ago. Matching that up, the peak PE valuation here, the peak PE valuation here, we had two others that were higher. So that's maybe the reason why we don't need to be as fearful of this, is because the PE ratios have been much, much higher based off of the S&P and the QQQ. But I come back full circle and say, if everything else is the same, in economics we call that ceteris paribus, all other things being equal, if every time we've seen this peak above the 2 standard deviations, we pulled back to 1, the linear regression, and to a -1. We've gone past 2, we pulled back to linear regression and to -1. What's to say that we're not going to have that happen here, where we have almost everything exactly the same? High interest rates, growth not going any faster, so the same growth rate as we had before, and this expectation that if this is being driven solely by the tech sector, like we've seen with the QQQ, and we're seeing this push higher because of AI, could we be looking for a pullback to here and then a pullback to here? And if we're looking at that, we're talking about a return back to 2010, 2011. If not, something more dramatic, going back to that 50% correction, we could be looking back to even lower. But even if we only go back to 2016, are we ready for that correction if this is a AI-driven tech bubble? If we look at the percentage shift from the tech bubble's peak and the pullback, where we went back into that negative number, or the -1 standard deviation, that was an 85% correction. In 2008, where we had a similar bubble and high interest rates, comparing the current interest rate to that, we had a 55% correction. If we go look at that and say, what about now? What if we were talking about now? Well, we already experienced some of the pullback, and some of the pullback was 37%. If we finish that off to 55%, or 70%, or 80%, a 55% correction brings us down sub 200. We're talking about drop to 184. From the current price, if we go to that same 184, we're talking about a correction of about 50%. And now we match that up to history, and that 184 takes us back to erase all the previous growth. And if we see it go all the way back to 2016, we're talking about a correction that is going to be from the current price, approximately 70 to 80%. If this is a similar tech bubble, 100, 120 could be on the table. And based off valuations, based off standard deviations, based off market valuations to GDP, based off the highest interest rates we've had in almost 20 years, the table is set. So we want to be really, really careful here. Doesn't mean we're going to sell off immediately, but remember that all the other times we saw it happen, at least pull back to the standard or the linear regression in 2-year time period. And here we are at the peak, 2021. So by the end of this year, we could be pulling back to a standard deviation. And the move to the -1 was within 4 years. So if this is the peak, and we're looking at that, we could be looking at a decline that could be seen by December of 25, which gives us about 1.5 years to 2 years to see that play out from this December. Well, that's going to do it for me today. Thanks for watching. Join me again next week, and have a fantastic night.